So this is PF7-34B from your book. It's basically a bank reconciliation. So let's get started. So the first requirement is to prepare the bank reconciliation. So it wants us to start with the bank side of it. So basically we have our bank statement that we're going to use kind of as a starting point. So let's see, we have our bank statement here. So we're basically going to start with the balance as of May 31st, 2024. So we basically start with this ending balance here. Remember, the key thing to remember is that you have to use the ending balance of the bank statement. It's a little confusing because you have this beginning balance, but basically what we're trying to do is to reconcile the ending balance of the bank statement with the ending balance of the book accounting balance. So just make sure that you're using the right number from the bank account statement. Again, we're using the May 31st, 2024 date. So that's going to be the end of the month. So just make sure you're paying attention to the date that you're reconciling. So as of May 31st, our balance according to the bank statement is $18,730. And so on the book side, or sorry, on the bank side, we basically want to take this bank balance and add and subtract the things that are in the accounting books but not yet in the bank statement. So the add is most likely going to be a deposit in transit. So a deposit in transit is going to be something where basically you've made a deposit into your accounting books because you've received checks or cash, and the money is in transit to go to the bank. So it's been entered into your accounting books but not yet hit your actual bank account. So let's see where we can find that information. It looks like there's some additional information here. And we have a checkbook here. Okay, so if we look on our deposits from the bank statement, we can see that there are several deposits that correspond to cash receipts here. So this May 4th, 4,230 in your accounting book, it got deposited on May 5th. And so let's just go down the list. So this one is included, this one is included, this one is included, this one is included. This one, however, 1,840, it was recorded in our accounting books on the 31st, but is not yet hit our bank account. So that's going to be a deposit in transit. So when we add that with our bank balance, we get, okay, so again, the point of this is to start with what's in the bank balance and then add and subtract what's in our accounting books but not yet reflected in the bank cash balance to reconcile it with what's in the accounting books. So, okay, so we've now added this deposit in transit because really the cash balance, if you don't add this, is understated in the bank because we really do have this 1,840 in cash. It's just that this statement has not yet reflected it. So we want to make sure that we are properly accounting for it. So now what we have to subtract, typically it's going to be either checks that have been written and not yet deposited or bank errors or something like that. So let's first do the checks outstanding. So in this data table here, we have in our accounting books all the checks we've written. And in the bank statement over here, we have what checks were actually deposited. So again, like if it has a letter next to it or these letters, then it's not a check necessarily that was deposited or cash. Like this is the EFT. This is, I think, is a bank charge. So so we look at the checks and other debits, meaning amounts that were taken out of our bank account. So let's see. So this NSF is a check that we thought we deposited, but was actually not ever added to our bank account. So we're not going to quite deal with this yet. That's going to be on the book side because our accounting books think that we actually had this cash, but we really didn't. But our bank statement does include it. So this is not something we have to deal with yet. But we see here we have check number 1416. So this one got deposited 1417, 1418, 1419. So all these 4 checks here have been deposited. However, we see that we have these 3 checks that have not yet been deposited. So we're going to have to basically subtract them out of our bank account balance because really this is overstated by these check amounts because these checks will eventually come out. The cash will eventually come out of our bank account, but it just hasn't yet because the people we gave the checks to have not yet deposited them. So let's reduce our cash balance by those 3. Okay, so we have the amounts. I'm just getting the amounts from right here. Then you add them up. Okay, so now we're going to have our adjusted bank balance by taking this amount and subtracting this amount. And I think, let's see if it works. I think since it says less, we don't have to put parentheses, but just keep in mind that you have to take this number and subtract this. Let's see if that is going to work. Okay. Okay, so now let's do the book side. So we're going to have a balance in our accounting books. It tells us up here 17750. That's what our accounting books unadjusted are saying that we have in cash. So what do we need to add? So the things that we need to add we're going to get from our bank statement. So these EFTs, this I guess BC is bank collection. So all this kind of stuff our accounting team never really encountered until they look at the bank account statement because they happen electronically directly with the bank. So we're now informed of these transactions that should be in our accounting books that are not until we do this reconciliation. So let's first look at these EFTs, or at least the deposits, because we're doing the add section first. So we have one EFT deposit for $450, and it says here that the EFT credit was a receipt of rent. Okay, so we're going to get some rental income here. So we have EFT collection of rent. And then what else do we have? We have this other bank collection here. And it says here the 1700 bank collection was for a note receivable. So bank collection of note receivable. So this was $450, which I got from right here. And remember, these are all deposits, right? So these are increases in our accounting book cash balances. So we need to make sure that these transactions are properly reflected in our accounting books. That's why we're doing this book side reconciliation. Okay, and then this is 1700 for a total of 2,150. So then we add our unadjusted book balance with this 2,150. Okay, so now what do we have to subtract? Let's look down here. So we have this NSF check that needs to come out because our book balance assumed that we will get this $1,100 when we deposited it. So we basically debited our cash balance when we received this check, assuming that the cash was going to come in, but when the bank actually tried to deposit it, it wasn't there, so we have to back that cash receipt out of our book balance. So let's do NSF check, 1100. And what else do we have? Okay, so it looks like there's an error too. The correct amount for check number 1419, which is in our books as 1090, is actually 1900. So what does that mean? That means we wrote a check for 1900, which was cashed, as we see here. But in our books, we actually only took out 1090. So we didn't take out enough cash for this rent expense in our accounting book. So now we need to take out more because our actual expense was higher by $810, and our book balance here is overstated by that because we only took out 1090 instead of 1900. So we need to take out 810 more to reflect the actual amount that was taken out of our cash balance. So this is a correction of a book error. And let's see, what else do we have? Okay, so then we have also this EFT of 375. So what was that for? So the EFT debit, which we're looking at here, was for an insurance payment. So we have EFT payment for insurance, 375. Okay, and anything else? Okay, so it looks like we have this right here. SC stands for service charge. We have bank fee, $35. That, again, the bank didn't send us an invoice or anything. We just are learning about this fee when we get the bank account statement. And so when we add all this up, so this is now the adjusted book balance, right? We're doing the book side. So we take this number, we subtract this number, and we get 17580. And the check that we need to do is to make sure that our adjusted bank balance and our adjusted book balance are equal to each other. We should end in the same point. We're starting in different places, but at the end, when we adjust for what's in the accounting books but not in the bank statement, and we adjust the book for what's in the bank statement but not in the accounting books, we should arrive to the same destination. Okay, so now we have some adjustments to make in our accounting books. All the stuff on the bank side are already in our accounting books. This deposit, these checks, these are all already in the accounting book. However, all the adjustments we made on the book side, all this stuff needs to be journalized because, again, we're taking what's in the accounting books and we have all this other stuff that we see in the bank statement that's not yet reflected in our accounting books. That's the whole point of this side of the reconciliation. So now we need to enter all this stuff into our accounting books to make our books accurate. So we're only going to be looking at the book side of the reconciliation when we're doing our entries for the bank reconciliation. So let's start with the EFT collection. Again, this was for rent. So we're going to have cash, right? All of these adjustments are going to involve cash. So we get cash of $450. And what was it for? It was for rent. It was rent revenue. So we memo it. Next, journalize the collection of notes. Again, cash is going to always be involved with these adjustments. So we take this 1700 and we're basically paying off a note receivable, which was an asset, which now someone has paid off. So we have to remove that from our books because it's no longer a receivable. Oh. It looks like I made a technical error. It's not an account receivable, it's a note receivable. Okay. Okay, now the NSF check. Okay, so we see in our additional information, this was for a receipt from a customer. So basically, we thought that we cleared out an account receivable when we collected this check from the customer, but no, that's not the case. The customer still owes us money, so we need to reverse this account receivable that we cleared. So we're going to recreate this account receivable, and we are going to basically reduce our cash balance that we thought we had, right? Because we thought we got this $1,100, but really our cash balance, if we do not make this adjustment, would be overstated. So we need to reduce our cash balance. We need to reinstate this account receivable. Okay, now journalize the EFT payment. So this payment was for insurance. So we have an insurance expense. And we have cash going out of $375. And then finally the service charge. So again, this is an expense. It's going to be a bank expense. It's cash that we're using to pay it. It's $35. Oh, and now we have the bank error, sorry, the book error, which was $810 for a rent expense. So we only originally took, according to our book, $1,090 of expense of rent, but really the rent expense was $1,900. So we need to take an additional rent expense of $810 to reflect what actually happened and reduce our cash by that amount. Because if you look here, our book said $1,090, but really in the bank statement they took out $1,900. So that's the actual amount of cash that went out. So our book cash balance was wrong. We need to correct the book cash balance to reflect this discrepancy. Okay, and that's it.